Now that we have a handle on what GIPS is and who is impacted by it, let's dive into the GIPS standards just a little bit. Now there's actually a lot of material here, and if we were really going to dig into this, this would take a long time. Luckily, what we're asked to do is fairly superficial analysis of these GIPS standards. So let's take a few minutes, dive into this, and of course this is the reading that we've been looking for since we started the ethics material. It's the last one, so hang in there for a few more minutes and you'll have this behind you. So the objectives here, again, what we want to obtain is global acceptance of calculation and presentation standards. We want this to be a fair, comparable format with full disclosure so that if I am a member of the investing public, which I am, then I can look at two money managers, I can look at their historical record, and I can feel confident that they are stated on a basis that is at least similar enough that I can compare one to the other. Right? So, given the number of ways to calculate return and compile data, that actually is a great step forward for mankind if we could achieve that. So we want to ensure consistent, accurate performance data. That is the reporting, marketing, presentations, all that sort of stuff is going to be something that we can rely on. We want to promote fair competition among the money management firms. And then we also want to do this promotion of self-regulation. So the idea of either we can do it to ourselves or we can have somebody else do it to us. Okay, well, it's almost always better to do it to yourself. So if we can all agree that this is the way we should do it, we have it verified. When I'm emperor, of course, we're all looking forward to that. But when I'm emperor, then GIPS won't be voluntary. Everyone's going to do it and is going to have it verified by a third-party verifier. So GIPS key characteristics. Right. So to claim compliance, the firm has to be a distinct business entity, right? And what that means is the firm is what we hold out to the investing public. And in our industry, everything's so nested, right? I mean, we have this company owns 14 others, and the different money management shops and all that sort of stuff, and subsidiaries, and it goes on and on. What is it that the investing public sees? That is the distinct business entity. So this is ethical standards for performance presentation, okay? And again, we're just trying to ensure fair and comparable performance. And again, include all actual, so there's not going to be any of this representative portfolio stuff, no back-tested portfolios based on this new model we've developed. This is going to be our actual fee-paying, discretionary portfolios that are going to be in the composites for a minimum of 5 years or since inception. So we have to have 5 years of data, okay, or since inception, and then if we have less than 10 years, we have to be adding one every year until we get to a 10-year GIPS compliant presentation. So we can do it with as little as 5, okay, but we got to get to where we have 10 years eventually, because if we're going to continue to claim compliance, then we've got to be adding a year every year as another year passes. So that's what we're trying to do, is make sure that we have all of the data in there, all of it put into the proper composite structure, which is determined in advance, so that we can have more fair and complete comparison between firms. So there's certain calculations, presentation standards are required. So how are we going to calculate returns? What's going to be included, numerator, denominator, those types of things, along with the appropriate disclosures. All that's going to be identified as within the characteristics of GIPS. Input data has to be accurate, so we've got to have safeguards on maintaining our data, compiling the data, those types of things. We have required and recommended provisions, just like we had with the standards of professional conduct. We had the guidance, then we had recommended procedures. Well, there's going to be some things that are required and other things that are going to be encouraged, but may not always be implemented because, of course, the world has lots of variation and it may not be appropriate in all cases. So importantly here, there's going to be no partial compliance. So you can't say something like, this presentation is compliant with global investment performance standards, okay, except for, this. So you can't comply, you have no partial compliance. Now you can use GIPS, say here's how I'm going to compile my data, but you can't mention GIPS and then say, oh, it's GIPS compliant except for, right? Because GIPS is a term that belongs to CFAI, and they say you can't do that. So if GIPS conflicts with local law, now this is a different scenario. So GIPS says we do this in a certain way. What if that conflicts with the laws of the country? Well, if GIPS is in conflict with the local law, then we follow the local law, okay, and disclose the conflict. So you can still claim compliance. Okay, you did everything you could do in GIPS. Okay, there was some place that you couldn't comply because of local law. Well, as long as you disclose what the conflict was between GIPS and law, you could still claim GIPS compliance, even though you weren't fully GIPS compliant, if that makes any sense, because of local law problems, then you could still claim compliance and just make the disclosure as the remedy. Let's see, so GIPS claim of compliance, this is the big carrot that everybody's looking for. So your firm name, Andy's Money Management Firm, has prepared and presented this report in compliance with the Global Investment Performance Standards, right? In compliance with GIPS. That's what I get to put on my report if I actually have complied with everything that is in the GIPS manual. So this is the GIPS compliance, and you can't have any partial compliance. I can't say Andy's Money Management Firm has prepared and presented this report in compliance with GIPS except for the calculation of what, right? So anyway, so you have to either be compliant or not mention GIPS. So there's no statement referring to calculation methodologies used in the composites or anything like that. So I can't say, well, this presentation includes composites where returns are calculated like they are in GIPS. That wouldn't be, you can't use this term, GIPS, unless you are claiming compliance, and if you're claiming compliance, it has to be complete compliance, with the minor caveat that it could conflict in some little country somewhere with local law, which would mean you would have to have this statement and then a disclosure, but that probably is down in the noise. Right, so the firm's fundamental responsibilities, okay, well, first of all, they have to provide compliant presentations to all prospects. They're going to have a composite list and a description of those composites that's available to anybody who makes a request. So if you're presenting your small cap emerging markets fund, here's been the returns over the last 10 years, and somebody says, well, what exactly does that mean? Then you've got to have some sort of document that will tell them, well, here's how we decided which of the portfolios that we have discretionary authority over went into that particular composite. So upon client's request, you provide a compliant presentation and composite description. What about joint marketing? So the real world's messy. So you have all this stuff that you want firms to do, but what if you have one firm that claims GIPS compliance and another firm that doesn't, and they want to jointly market their products to some investor group? Well, then we've got to separate the compliant and non-compliant aspects of the presentation. So if we can do joint marketing, but we've got to make sure and separate what is compliant from what is not compliant so that we're not confusing investors. And the firm definition and historical record. To claim compliance, the firms are defined as a distinct business entity, and that means what is held out to clients. So it may be that it's a subsidiary, but that subsidiary is well known, and that's what's the name that's on the building, and that's who's the name on everybody's business card. Well, that's the distinct business entity that's held out to clients. That is the entity that has to either claim GIPS compliance because they complied with GIPS, or not mention GIPS at all, right? So if you're doing this, you're going to claim compliance with your business entity that's held out to clients or held out to the investing public. Then you have to include all actual fee-paying discretionary portfolios, like we said previously, okay, and the composites, and they have to be for a minimum of 5 years or since firm or composite inception. So if you've only been in business 3 years, okay, you can claim since inception, okay, working to 5, right? And then if you're at 5, you got to add 1 every year in order to be able to continue to claim compliance. So you have to add 1 year of compliant performance history each year until you get to 10. And the idea is, look, I'm going to have to go back and reformat all my data. Maybe I'm just going to report 5 years because I've got a lot of work to do here, and records were in different formats, all that type of thing. Well, I can do it for 5. Okay, and I'm just presenting those 5, but then I've got to, from going forward, I've got to maintain GIPS compliance and have their data in the right format, those types of things, until I get to 10 years, and then there's no requirement that you present more than a 10-year history. All right? So what about, we used to have these country versions of GIPS. So in other words, we'd have one thing in the US and we'd have something else in Sweden or whatever it was. So these were specific country versions of GIPS. That's what this CVG is, country version of GIPS. Well, these are almost out of the curriculum. I've been waiting for this for a long time. Okay, but anyway, so these were something that existed prior to January 1st of 2006. So once we get 10 years past that, then we don't have to worry about it anymore, although you could still see this show up on the exam for a while just because it's been in the curriculum, and it was an issue for a long time about who complied with what and when did they start and those types of things. In cases where we had country-specific regulations that are different from GIPS, we have to follow those country-specific regulations and then disclose the nature of the conflict with GIPS if we're going to claim GIPS compliance. So we already said that, but here it is again. So this notion of when you have this caveat about not having full compliance with GIPS, okay, and still being able to claim compliance, the only exception, at least the only one I know of, is if you have some sort of conflict between the GIPS standards and local law. To finish this off, we've got the 9 major sections of GIPS, and this is, I think, relatively straightforward. This is where the work would come in if we had to dive into each of these individual sections, but all they really want us to know here, according to the learning outcome statement, is what the sections are and basically what would be contained in each of those. So this is really not quite as bad as it looks. There are 9 sections, but note that it starts with 0 instead of 1, so they're numbered 0 through 8 instead of 1 through 9. So section 0 is the fundamentals of compliance. This is issues for the firm to consider when claiming GIPS compliance, including the definition of the firm, right? So this is a big deal. What is the firm? And again, that's going to be what's held out to the investing public. But you have to, once you've determined what is the firm, then everything has to be done on a firm-wide basis. Okay, section 1, input data. Okay, this has to be consistent, okay, and it has to have full, fair, and comparable performance presentations. So that is, or to facilitate full, fair, and comparable performance presentations. So we have to have the input data right, and that is not always as easy as it sounds, given how portfolios are structured and when they commence or when they come into the stable. Not everybody starts with a new money manager on January 1st, and then if they're leaving, leave on December 31st, those types of things. So this becomes actually kind of tricky. So the calculation methodology, well, there's requirements about how you're going to calculate return, how you're going to impound the impact of cash flows, when they come during the year, all that sort of stuff. And this is just going to make a uniform approach to the calculation once we have the data that we've gathered in section 1. So section 3, composite construction, I think we've talked that sort of to death, but we're going to create meaningful asset-weighted composites. Once again, that's all of our actual fee-paying discretionary portfolios. Okay, whether they're still with us or not, all of those are going to be included somewhere in a composite, and it has to be a composite that is in some sense meaningful. It tells us something about what was the standard to which these portfolios were measured. Disclosures, certain information has to be disclosed about the presentation. That is how we made the calculations, where you can turn for more information, all those types of things. 5, presentation and reporting. This is present the investment performance according to GIPS requirements. That is, the 5 years, add 1 year every, all those types of things. So if we're going to, the whole notion here is we are managing money. We have a performance record. We want to present that to clients and prospective clients. Well, this section 5 is talking about how we do that, what we have to say, what the required disclosures are, and the like. 6, real estate. So the provisions also apply to real estate investment, regardless of the level the firm has, level of control the firm has over the property. So if I own the property and I manage it myself, or if I'm investing in some other way as a limited partner, those types of things, all that is also going to be calculated according to the real estate section here for in section 6. Section 7 is going to be private equity. You get to see this at different points in across the curriculum, but we're going to value, according to the GIPS, private equity valuation principles. So GIPS specifically says private equity valuation principles, and we're going to report the performance of the private equity fund according to those principles, right? But there is an exception. If it is an open-ended fund, okay, meaning that you can get in or get out, okay, or it's an evergreen fund, meaning that it, you never get your money back, sort of like a university thing. This would be a private firm, but it's going to go on and benefit some endowment forever, those types of things. Okay, then the reporting is going to be different, and you're going to follow regular GIPS. Okay, but if you're talking about the typical private equity investment, you're going to have a limited partnership structure. You're going to have a general partner. It's going to have, they're going to raise some money. They're going to invest over some period of time. Then they're going to liquidate. Well, that's where you're going to use these private equity valuation principles that are specified in Section 7. And then Section 8, I'm sorry, so Section 8, that's the last. Remember, there's 9 sections. We started numbering with 0. Is fairly perfunctory again. This is for a wrap fee or a separately managed account, an SMA. Okay, and this is really a supplement to these sections 0 through 5, where we went through, what was the definition of the firm, what was the data, how do we calculate things, all the way up through what did we actually present, what were the disclosures. So for separately managed accounts, okay, these are specific, I guess, conditions that would deal with those. So section 0 through 5, specific reference to those provisions that don't apply to the wrap accounts or the separately managed portfolios, and some provisions here that supersede those in sections 0 through 5. And luckily for us, we don't have to be familiar with exactly what is superseded. We just have to know that we would have a section telling us how to do that if, in fact, we were going to do it. Congratulations. If you started listening to this at the very beginning, that was like 4 or 5 days ago probably, or at least it seems like that long ago. You have now watched all the way through the ethics material. I think that, well, I'm hoping anyway, that these videos can be valuable in sort of parsing out the material, bringing some insight and intuition into the material, because I think there is some that you can gain by, careful study or reading or listening to somebody who's had to do that a number of times. But I will also tell you that in order to really understand this, you're still going to have to dig in, underline, take notes, those types of things, because on the exam, this is going to be tested with a high degree of specificity, and it's going to be something that's going to be challenging. I think you have to spend time with the ethics material in order to be able to do well on the exam, or spend time with it just to avoid shooting yourself in the foot might be another way to express that. So while it is not necessarily the most exciting material that you're going to cover as you pursue your charter, it is material where there are lots of points up for grabs, and where you can get a substantial portion of those points if you're willing to dig in and, like I say, underline, take notes, and when done that, make sure you've answered lots of practice questions on it, because there is an intuition that comes from answering ethics questions that is separate from what ethics might be in the real world. So having answered lots of questions on this after you've gone through the specifics, I think you will find as an effective means to boost your score on exam day. Good luck.